All right, so this video is chapter 3. We're going to be talking about adjusting journal entries, adjusting basically the accounts for our financial statements. Um, this is kind of where I typically might lose students, all right, not lose them like they drop the class or anything like that, but it's where they start having more difficulties, all right? So if right now you have struggled through chapters 1 and 2, get a good feel, a good hold on those before proceeding to chapter 3 right now, okay? Please make sure you understand this stuff before jumping into chapter 3. Chapter 3 is a little bit of different concepts than what we're used to living with, and we're going to get into that in a bit. So just focus on that and make sure that you're ready for chapter 3 when you jump into it. And again, if you have any struggles or whatever, you're always welcome to come talk to me about it, and we can go over some things, okay? All right, so let's see. There we go. Here are your learning objectives. As always, you can pause the video and look at these to understand what we're going to be going over in this PowerPoint slide. Okay, so we talked about the time period assumption in chapter 1, where we assume we can break accounting periods up into time groups. You can see that we have monthly, quarterly, semi-annually, and annually. What's not shown here is that the 18-month period that I kind of also talked about. Don't worry about that 18-month period. It's very rare. It does happen, but very rare. But also don't worry about the semi-annually either. We really don't deal with half years either. It's usually monthly, quarterly, or annually where we focus on the accounting period. Now, before I get into that, remember that our revenue recognition principle and our matching or expense recognition principle says that we're going to recognize our revenues in the accounting period they were earned, not necessarily the cash we received, and we're going to recognize our expenses in the accounting period in which we used them, not necessarily when we paid for them. Okay, that's the big key here, because when we combine those two assumptions with the time assumption, we get the accrual basis of accounting. The accrual basis of accounting is that we record our revenues when we do them, when we perform the services, and we record our expenses when they're incurred. When you couple those together, we're talking about the accrual basis of accounting. The cash basis of accounting is what you are used to. Whenever you work for an employer, you don't recognize the cash that you've received as revenue until you get it, right? And you don't recognize any expenses until you paid it. Think about it for tax purposes. When you do your tax forms at the end of the year, let's say the last time you got any money from your employer was December 22nd, all right? The next pay period you're going to get paid on is January 3rd. Well, you're not going to see that pay that you receive on January 3rd till the next year. But in accounting, if you were on the accrual basis of accounting, you would have to account for every day that you did work at the end of that year and include that revenue in the current year because you worked it during that year and you earned it during that year. That's kind of the main difference with the revenue side of things. Expenses are the same thing. Now, with the exception of some expenses for taxes, if you've expended it in the, let's say 2000 and, well, I don't want to say that because I don't want to date this, but basically in the current year, if you've expensed something that you can deduct when you file your taxes in April or the next year or whatever, beginning of next year, you can use those expenses. But if you started having expenses in the beginning of January, or you're paying for them, even though they may have occurred in the prior year, you don't get to expense those on your tax return because you didn't expense them until the next year. Well, that's not the way it is for accrual basis. When you have the expenses and you incur that liability, whether you paid for it or not, it doesn't matter. We're going to expense it in that prior year. Okay. So that's the big difference between accrual and cash basis. Again, we have had the cash basis of accounting kind of smashed into our heads. That's how we've lived our entire lives. And so I'm asking you to think of things a little differently here. All right, so here's the accrual basis versus the cash basis, and this is an example, okay? It's a pretty good one. We have $100 of insurance expense. No, this isn't a good. They must have changed it. All right, so look at the transaction here. It says paid $2,400 for 24 months coverage beginning December 1st. If we're doing the accrual basis of accounting, we're going to expense $100 each month. The first one in December of 2021, then $100 each month of 2022, and then in the 2023, we're going to expense $100 except for December because we've used it up as of November, in November. That's the accrual basis of accounting. If we use the cash basis of accounting, we are putting it all in December, all that expense in December. See, that's what it's saying here, and nothing in the other ones. Even though we're using that insurance over the course of 2 years, we would expense the whole of it in that first year. That's why we don't like the cash basis of accounting in accounting. We don't like it. All right, revenue recognition principle. Remember that we are going to record our revenues when we've earned them, when we provided the service or the goods to our customers, and we expect to receive money or some kind of enumeration from them. Same thing with the expense recognition or matching principle. We are going to recognize these expenses in the accounting period that we used them, not necessarily when we paid for them. A lot of times we don't pay for them right away. So these are the 4 things that we need to do. What we do, and the whole point of this in chapter 3 is making these adjustments for these timing issues that we have. We're going to be adjusting our accounting, our revenues and our expenses to reflect when they actually were incurred and make sure that we recorded them in the correct accounting period. So there's 4 areas we're going to look at, and we do a 3-step process. All right. Now, this is the way the book teaches you. I'm going to show you the way I know it the best. Okay. So you can either take the book's way or you can take my way, or you could even come up with your own way, patent it, and make tons of money. Either way is great. All right. As long as you do it right and you get to the correct answer, that's fine. Okay. This one says determine what the current account balance equals. Determine what the current account balance should equal, and then record an adjusting entry. There's some accounts you do that with, some you don't. Deferral of expense, deferral of revenue, accrued expense, and accrued revenues. Let's go over those, okay? Here we go. We're going to start with the deferral of expenses. So, in other words, we have purchased some expenses in advance. These are deferred expenses, right? We're deferring these expenses to later on, meaning we've paid for them today, but we're going to use them up as we go along. These are all the prepaid types of expenses. Now, we've talked about supplies in the prior months, in the prior videos, but supplies is really a prepaid supply expense account. We're buying the supplies in advance, and then as we use them, we're expensing them. It's the same thing as prepaying rent, and then as we use them. Prepaid insurance, as we use them. It's the same concept there, okay? Bottom line is, we have an asset. It has a debit balance. We've used some of that prepaid account. So we're going to have to adjust it. We're going to expense that asset account so that we can reduce it to the level it should be at. For example, supplies. Supplies is a really good example, actually. If we have supplies, we bought all these supplies. Let's say it's $1,000 worth of supplies. We're not going to keep track of all the pens and paper and all that stuff that we've used as you use them. But what we're going to do is we're going to send an intern around or someone that's brand new. And at the end of the month, quarter, year, whenever, they're going to have to count how much we have of everything. And then we're going to see how much we had, how much we bought, and where we're at, and come up with how much we need to expense. That's how we're going to do this, okay? So with that, let's do this example. Fast forward, paid that $2,400 to cover insurance for 24 months that began on December 1st. Fast forward, recorded the expenditure as a prepaid insurance. Okay, so here we go. There's that $2,400. Got it? The balance of the prepaid insurance account should equal $2,300. All right. Now we're going to know this one of 2 ways. We either know that the expense is $100 a month, or we know it should equal $2,300. Most of the time, we're going to look at it from the standpoint of how much is it per month? Okay, it's $100 per month. Okay, so we just got to reduce this by $100. So we're going to credit the prepaid insurance and debit our insurance expense. But the way the book says is that you should know that it equals 2,300. Um, I don't know how. I'm trying to think of any kind of accounting program that wouldn't record that anyway. So if you know it should be 2,300, it's only because you calculated it as $100 a month. So anyway, sorry, the phone interrupted things. Um, so we're gonna go ahead and adjust this by, like I said, I think I already said it, debit the insurance expense by 100 and credit the prepaid insurance. So now our prepaid insurance account balance will be 2,300, like we said, and we're gonna put that on the balance sheet. Now here's another thing too. I'm glad I saw this here. Each adjusting journal entry is going to have only two accounts. One of them is going to be on the balance sheet, and one of them is going to be an income statement. In other words, one of them is either going to be an asset, liability, or equity, and the other one is going to be a revenue or an expense every single time. Okay, so make sure that you understand that. So our prepaid insurance is an asset, it's going to the balance sheet. It's going to show 2,300. Insurance expense, it's an expense, it's going to go to the income statement. Okay, so now it's showing you the prepaid and the T accounts. We posted it. There's our journal entry to record this adjustment. All right, here's supplies. Same concept. This one's a little more understanding. This is kind of what I gave you at the beginning. So we purchased $9,720 worth of supplies in December, all right? And we're assuming we had zero at the beginning of this account balance because we just started. So we've increased during the year 9,720. But we sent someone around to do a physical count on December 31st. Instead of going to their New Year's party, we made that person go around and count supplies. Boy, we are evil, aren't we? Just kidding. We know the balance is 8,670. So now we're going to calculate it backward. By subtracting the balance we know we have today out of the initial balance, we know we're going to make an adjustment of $1,050. So we're going to credit supplies and we're going to debit supplies expense. Supplies balance sheet, supplies and expense go into the income statement. Here's our journal entry. We see them posted to the T accounts, and there is our journal entry. All right, depreciation. All right, I think these slides, and I forgot to do that. Yeah, I'm gonna skip over some of this. I'm not gonna ever make you calculate depreciation. I'm gonna teach you that in accounting 112. All you have to know is that when we make this journal entry, it's going to impact depreciation expense, that's our debit, and accumulated depreciation over as the credit. Depreciation is basically this. When we buy something that's going to last us longer than 1 year, we can't expense that full amount in the same year, right? We're going to spread it out over the life of the asset. Now, since we don't really know how long that asset may live, we don't know what's going to happen, if it's going to be in an accident or something's going to do something to make the useful life of that asset to no longer be as useful as it was. For example, a car. You get in an accident, the transmission could get blown, the engine could suddenly seize up because you forgot to do proper maintenance. There's a ton of stuff that could happen. But we assume it's going to last longer than 1 year. Okay, so what we're going to do is we're going to say, this vehicle should last around this much time, and we're going to go ahead and expense it each month or each year based on how long we think it's going to last. Okay, and that's the whole concept of depreciation. Again, don't worry about calculating depreciation. Don't worry about the straight line methods and all this other stuff like that. I will be teaching it to you later on. But we don't decrease the accumulated or the account that we're considering depreciation. Don't worry about it as to why we do that. Just trust me on this one, okay? We'll learn about that more in Accounting 112. I don't want to throw that at you right now. But the bottom line is we have this accumulated depreciation account that is tied with that, like for in this case, equipment. That accumulated depreciation would then have a hyphen next to it and say equipment. We're tying it to that equipment account. And so when we show this on the balance sheet, it's going to show equipment, then it's going to show accumulated depreciation as a reduction, and then it's going to be the book value that we're going to see on the balance sheet with the depreciation expense going to the income statement. And I'm always going to give you the amount. I'm always just going to say depreciation expense 300. And then you're going to do this journal entry. Okay. That's all you got to worry about. Counting 112, we'll learn how to do the actual calculation, but for now, it's just the total amount. And this is what I was explaining to you on the balance sheet, what book value looks like. It's the equipment amount minus the accumulated depreciation that's tied to it. Again, it's just how we present it, so you don't need to worry about it right now, but that's how we do it. You do need to do this when we have the accumulated depreciation and stuff, but that's what we want to look at. All right, so now we're going to adjust entries for deferrals of revenue. So basically what's happened is someone's paid us in advance to do work. And so we have to record any work we've done and show that it's no longer a liability and that we've actually earned it. So if someone prepays us money and we haven't done the work yet, we record that amount as a liability. We never do that work, we got to give that money back. It's plain and simple. It's like those concerts. You prepay a concert, they have something come up like COVID and they can't perform, they got to give you your money back. They don't earn it until they do the concert. So normal account balance on a liability is always a credit. So we're going to have to debit that liability when we do the work. So let's go with, well, let's see what example they have for us. A client paid a 60-day fee in advance covering the period from December 27th to February 24th. We're going to look at this in time period of days. So we're going to have 5 days pass out of 60. They paid us, looks like $3,000 to do this work. So we're going to take 5 divided by 60 to represent the total amount or percent of that we've earned because of the opportunity we have to do the work. The fees that, I guess it's consulting fees, I think, that we've earned those 5 days of consulting fees. So we do this calculation, we account that it's $250 a day. That's pretty good money. It's not bad. I mean, if you think you're, consulting, basically, I think this is basically, hey, we're here for you if you need it. So $250 to do nothing. Yeah, there it is, consulting revenue. It's not a bad gig. Not a bad gig. So we move it from unearned consulting revenue to revenue for $250 dollars times 5. So let's find out. Oh no, I'm sorry. It is 250 is the 5 days work. So that's not a good deal. I mean, I guess if you're still not doing any work, but either way. So we're going to debit. Well, first of all, yeah, I'm sorry. This is showing when we got the money. On December 26th, when we got the money, we debited cash and credited unearned consulting revenue. Then we're going to make the adjusting journal entry to show that we've earned $250 of this. We're going to debit the unearned consulting revenue, which is a liability. Normal balance is a credit. So its balance is going to be $2,750. And then we're going to include the $250 in revenue because we've earned it at this point. There you go. So here's our adjusting journal entry, debit to unearned consulting revenue to consulting revenue. Now we're going to prepare adjusting entries for accrued expenses. Now these are expenses that we have used, but we haven't accounted for yet. We haven't recorded them yet. The most common of these is utilities, okay? So when we realize that we have these expenses that we haven't recorded yet, we're going to debit the expense and credit the liability because we realize we owe it at that point. So this is a good one too, employees' wages, okay? So like I said before in the beginning of this video, we have employees working the last part of the week that might carry over into the next year and they're not paid until that next year. When that happens, as the company, if we're on the accrual basis of accounting, we have to record what labor we used and how much we owe them as of December 31st. So this situation here is that Fast Forward pays its employees $70 per day or $350 for a 5-day work week. And then salaries are paid every 2 weeks on a Friday. On 12/31, it's a Wednesday, so 3 days salaries are owed at year end. So we're going to take that $70 a day times by 3 days, $210 what we owe our employee for each employee. In this case, I guess we're only going to say we have one. So what we're going to do is we're going to increase our liability and increase our expenses. So our salaries payable will increase, and so will our salaries expense for $210. And there's your adjusting journal entry. Here it is posting to the T accounts, or the general ledger, or the ledger accounts, I should say. So we're going to show that we owe $210, and we're going to expense that $210 in the accounting period in which we have earned it, or used it, excuse me. In the future, when we pay for this, actually, we're going to accrue additional periods of expenses. So we're going to have that salaries payable liability we're going to get rid of, the $210. We're going to finish paying for the 2 weeks, so that $490, and we're going to pay cash out of $700 to that employee. And that's how that works. So what about accrued revenues? Revenues we've earned but not yet recorded, okay? Same concept, except we're just looking at it from the asset and revenue side. So when we do work, and at the end of the year, we're going to say, hey, what work have we done that we haven't billed for or anything like it? What we're going to do is we're going to debit our assets and we're going to credit our revenues. We're going to debit accounts receivable because we haven't received the money yet. We're going to credit the revenue. So in this situation, we have a customer who agrees to pay $2,700 on January 10th of the next year for future services over the next 30 days. So this is on December 12th. So on December 12th, we record a debit of $2,700 to cash and a credit to unearned revenue. Then on December 12th, 31st, we know we have 20 days worth of services that we have provided. And we realize that it's 20 divided by 30, excuse me, times $2,700 to find out we're owed $1,800. If at some point we say we're not doing the contract anymore, we're done, barring any other legal ramifications, they owe us that $1,800. Even though we didn't finish the contract, they owe us that money. Our journal entry will be a debit to accounts receivable and a credit to consulting revenue, $1,800. Here's our posting to the T account. But you see what is our account balance should be? Well, how do you know that unless you do the calculation? That's why I really don't like the book way of doing it. It's kind of awkward in my opinion. Once we actually receive this money, well, we're going to have to receive the cash, $2,700. Then we're going to get rid of that receivable by crediting it. Normal balance on an asset's a debit. To get it reduced, we're going to credit it. And the remaining amount that we've earned in the current accounting period, we're going to record as a revenue for that accounting period. All right. Here's a good little chart, exhibit, whatever, that you can pause this on and maybe jot some stuff down or whatever, but this is a good one to kind of look for. All right, so once we have, having a hard time breathing today for some reason. I think I need to grab a water. Ugh, I apologize. Once we have all these adjusting journal entries, we're going to post these to our trial balance. We had our trial balance before. Remember, we did that in chapter 2. Now we're going to put these in here, and that was called the unadjusted trial balance. Now we're going to have the adjusted trial balance by posting these. So this is the unadjusted trial balance example we did in chapter 2. Okay, we make all of our adjustments that we just did and what we talked about, and now this is our adjusted trial balance. This is a worksheet that shows all this stuff. You'll learn how to use this worksheet in chapter 4, but this is kind of how it looks like and how we set it up, right? From the adjusted trial balance, all right, we're going to do our steps to create things. Again, step 4, we're not doing the cash flow statement, so don't worry about it, okay? We are going to move our accounts from, and remember again, look at this. Revenues are the 400s. Expenses are the 600s. Then everything else goes on the balance sheet, okay? Except the capital accounts we're going to put on the statement of owner's equity. So we're going to take all the revenues. It's only 2 of them. Boom, throw them here. Take all the expenses, and we got our net income. And we're going to take our beginning balance of our Taylor capital account, add in our investments by the owner, and the net income from the prior statement. Subtract out the withdrawals, and that's going to be our ending balance. We're going to put that on the balance sheet. and then just basically list out our liabilities and assets. And you're done. And that's your financial statement. All right, compute and analyze profit margin. I'll let you kind of look at this on your own. Again, it's more of a familiarization. Net income divided by net sales is your profit margin. I am not going over alternatives in the prepaid account. Okay, so we're going to basically just skip to this is the end of the chapter. Okay, if you have any questions, let me know. Let's go over it together. I am looking for my list sheet of, here it is. Okay, so your word for this video is download. DOWNLOAD. One word. DOWNLOAD. Download. Okay, like I downloaded all of my homework off the internet so I could do it over the summer and do it over several times. All right. Hey, you guys have a good one. We'll see you in chapter 4, if not sooner. Have any questions, let me know. All right. All right. Take care.